three key biases that drive investment decisions. With markets at all-time highs, there's a lot of conversation currently around what one should do with equity investments. Investments are very often about the data, about the research, and the economics. But more than that, they are very often about how investors behave as a collective group and as we behave individually. We have spoken about multiple biases in the past, including loss aversion, delayed gratification, etc. Today, we're going to talk about three others that we think are very, very important for you to keep in mind as you make investment decisions going forward. The first one is what is called a confirmation bias. Confirmation bias essentially makes us look for data that agrees with our view and our thesis. So, for example, if we are bullish investors, we may actually look for data to support why something which is coming through is actually positive. And therefore, we could discount everything else which is negative as saying that this is a one-off event. In contrast, something which is for someone who's bearish will look for those areas where things are a problem and focus our energies there. I think it's very important for us to be aware of this confirmation bias and seek multiple opinions so that we can get over it. The second is what is called an overconfidence bias. Bull markets can make us believe that we know much more than everyone else does. And in an era where making money seems like a very, very easy thing to do, this can get magnified very significantly. Essentially, an overconfidence bias, as the name suggests, is essentially overestimating our own abilities over the abilities of everyone else and making decisions as if nothing can go wrong. We are seeing the regulator in India, SEBI, for example, caution investors against F&O or intraday investments by putting out lots of data to show how investors lose money. But essentially, if you're overconfident, you're going to dismiss that data and say that this can't happen to me. You need to keep in mind that very often this is coming from the fact that nothing has gone wrong earlier, and therefore you think that the same thing will continue, which is what overconfidence bias is about. Number three is a sunk cost fallacy. Essentially, with a sunk cost fallacy, what happens is you continue to buy something, for example, which is not doing well, simply because you've already put money into that. For example, if you bought a stock that hasn't done well, you now start to average out, saying that, by putting more money, my average cost price will go up, and therefore I will start to make money. Remember that your decision to add any more money into an investment has to be driven by the merits of the investment rather than the cost at which you purchased it at. So all in all, be aware of these biases, look for data independently, talk to multiple people, get multiple perspectives before you make any decision in a bull market especially.
Disclaimers. Investments in securities market are subject to market risks. Read all the related documents carefully before investing. Registration granted by SEBI, membership of BUSL and certification from National Institute of Securities Markets, NISM, in no way guarantee performance of the intermediary or provide any assurance of returns to investors. The information is only for consumption by the client and such material should not be redistributed. The securities quoted are for illustration only and are not recommendatory. This material is for information and educational purposes only.